Capital gains taxes can be one of the most interesting concepts in the entire tax industry. Many people mistakenly believe that there are only short-term capital gains and long-term capital gains, and that is wrong. There's a lot more than just that. So to get started, let's talk about what are short-term capital gains, what are long-term capital gains, and then what are the different variations between just those two. Short-term capital gains are profits that you make whenever you sell an asset that you've held for 1 year or less. Long-term capital gains are profits you make from selling an asset that you've held for longer than a year. Short-term capital gains are taxed at ordinary income rates, and long-term capital gains are taxed a little bit more favorably. They're taxed at either 0, 15, or 20% by default. A quick hack out there, for 2024, if you are married filing jointly and you have taxable income of $94,000 or less, you're actually going to pay 0% on all of your capital gains for that year. Then between $94,000 and $583,000 of taxable income, you're going to pay a 15% capital gains rate. Anything over that, you're going to be hit at 20%. For single filers, the thresholds drop a little bit. The 0% capital gains rate applies to any income of around $47,000 or less if you're single, and then anything above $47K but below $518,000 is going to be taxed at the 15% rate, and then anything above that taxed at 20% rate. So the exact numbers: the 0% at married filing jointly, $94,050, and then between $94,050 and $583,750, that's the 15% capital gain rate, and then anything above that is 20%. For single, the 0% is anything below $47,025, 15% is anything above that but below $518,900, and then 20% is anything above that. These are long-term capital gains rates that I just gave you.